The power of compound interest for high net worth investors. Welcome back to our channel, where we explore the strategies and insights that drive wealth growth and preservation for high net worth individuals. Today's topic is one that can significantly impact any investment portfolio over time: the power of compound interest and how it can work as a powerful tool for building and protecting wealth. Let's dive in. Introduction to compound interest and why it matters. Compound interest is a financial concept so powerful that Einstein famously called it the eighth wonder of the world. In essence, compound interest means earning interest on both the original investment and the accumulated interest over time, leading to exponential growth. For high net worth investors, this concept is not only relevant but essential. Compound interest acts as a foundation for long-term wealth building strategies, especially when it comes to reinvesting returns. Unlike simple interest, where you only earn interest on the principal amount, compounding builds upon itself, multiplying your returns over time. So, how does this impact high net worth investors specifically? The larger the principal, the more significant the impact of compounding. And with the ability to access opportunities in assets with compound growth potential, high net worth individuals can leverage this exponential growth even further. How compound interest impacts various investment vehicles. Let's explore how compound interest impacts different types of investments that high net worth individuals often focus on. 1. Stocks and mutual funds. Compounding in stock market investments works through capital appreciation and reinvestment of dividends. In a diversified portfolio, high net worth investors often take advantage of compounding through reinvesting dividends. For instance, if a portfolio earns a 10% annual return, reinvesting dividends allows those returns to grow exponentially over time. 2. Bonds and fixed income investments. Fixed income investments, like bonds, are also vehicles for compounding interest, especially if one opts for bond funds or reinvests coupon payments. Wealthy investors often use tax-exempt municipal bonds or government securities, where returns, when reinvested, steadily accumulate. Although the returns are lower than high-risk investments, compounding in safe assets provides stability. 3. Real estate. Although real estate does not generate compound interest directly, it can still benefit from compounding in terms of rental income reinvestment and appreciation over time. By reinvesting rental income or refinancing and reinvesting profits into new properties, high net worth investors multiply their wealth over time. The strategy lies in acquiring appreciating properties, creating a compounding effect through value growth, reinvested rental income, and equity building. 4. Private equity and venture capital. Another high-impact area is private equity or venture capital investments. Here, compounding isn't as direct as it is with dividends or fixed income. However, reinvesting the profits from successful exits or high-growth companies back into new ventures can lead to exponential growth. High net worth investors often leverage the compounded returns from these lucrative but riskier ventures. Tax efficiency and compound growth. High net worth individuals know that tax planning is integral to optimizing compound growth. Because taxes can severely diminish the growth potential of compounding, tax-efficient investment strategies become essential. 1. Tax-deferred accounts. High net worth individuals use tax-deferred accounts like 401ks and IRAs for retirement, where the growth is tax-deferred until withdrawal, allowing compound interest to have its full effect over time. 2. Municipal bonds. Tax-free municipal bonds offer another tax-advantageous way to compound wealth for those in higher tax brackets. 2. Since interest on municipal bonds is typically tax-free, reinvesting these returns can have a compounding effect without tax erosion. 3. Trusts and foundations. Many wealthy individuals use trusts or charitable foundations to shield investments from taxes. 3. Trusts, especially irrevocable ones, allow assets to grow tax-free, preserving wealth through compounding for the next generation. The role of patience and long-term thinking in compound growth. For compounding to be effective, time is key. High net worth investors often plan their portfolios with a long-term view, allowing compounding to work its magic over decades. The greatest barrier to compound growth is the temptation to withdraw or shift investments frequently. Investors who allow their wealth to grow uninterrupted tend to see the highest returns. This is one of the reasons why many high net worth individuals focus on multi-generational wealth planning. By creating structures that benefit not just themselves but future generations, they maximize the power of compounding, often setting up funds to grow over generations. Compounding in action. Hypothetical examples for high net worth investors. Let's look at a few examples to illustrate how compounding works over time, especially with larger initial investments that high net worth investors often have. 1. Equity investment. Consider an initial $1 million investment in a balanced stock portfolio that returns an average of 8% per year. 1. In 30 years, this $1 million will grow to over $10 million due to the effects of compounding. 2. Real estate portfolio. Imagine an investor who buys properties worth $5 million, which appreciate at an average of 4% annually. 2. Over a 20-year period, even with modest appreciation, this portfolio could potentially double in value, and if reinvested smartly, could grow even more substantially. 3. Private equity investment. Suppose an investor places $500,000 into a private equity fund with an expected annualized return of 15%. 3. After 20 years, the investment could grow to over $8 million. 3. The risks are higher here, but the compounding effect in high growth areas can yield tremendous returns. Strategies for maximizing compound growth for high net worth investors. There are specific strategies to maximize compounding. 1. Focus on high return assets. By allocating part of their portfolio to higher return assets, such as private equity or tech stocks, investors can significantly enhance compounding effects. 1. Even a small allocation to higher risk, high return assets can yield considerable compounding over time. 2. Reinvest returns regularly. This is the golden rule of compounding. 2. Every dividend, interest, or profit that's reinvested fuels compounding growth. 2. For example, reinvesting dividends from stocks or rental income in real estate can amplify growth over decades. 3. Diversification. Diversifying helps to mitigate risk while allowing for compounded returns. 3. By creating a balanced portfolio that includes both stable, compounding assets like bonds and high-growth opportunities, investors can protect themselves from volatility while still compounding wealth. 4. Minimizing withdrawals. Compounding works best when you let it grow uninterrupted. 4. Many wealthy individuals set strict guidelines to avoid withdrawals, allowing compound interest to work over the long haul. In summary, compound interest is one of the most reliable and powerful tools available for wealth building. High net worth individuals can leverage the effects of compounding across various asset classes, each one contributing to a portfolio that grows exponentially over time. The true power of compounding lies in its ability to amplify returns, preserve wealth across generations, and provide financial freedom. Thanks for watching, and if you found this information valuable, please like, subscribe, and share. Keep building your wealth the smart way.